Hello class, this is Dr. Fenton. In this video, we will talk about Chapter 9, which discusses responsibility accounting. Let's get started. The first topic is decentralization. There is an organization chart right down here. Let's take a look at. And you can see for a large company, we have several layers of responsibility. We have the upper level, corporate headquarters and so forth, different divisions, and then one division might have several subdivisions under it, several different corporations that have several segments of products. Then under one of it might have various sales departments, planning, accounting department. Under production you might have cutting, assembly, and finishing. So here we have an example of 5 levels of an organization chart. And we're going to come back to this chart in just a minute as we look at some statements in just a second. Now, in decentralization, we allow the people at these lower levels in the business, levels 4 and 5, to make decisions that they are responsible for in their different departments or different corporation segments or whatever. So instead of upper management making all the decisions for the company, we decentralize the decision-making process and allow people in these areas that probably know more detail about these areas to make decisions. Let me go up a little bit. So why would we want to encourage decentralization? Well, it encourages the upper management level to concentrate on strategic decisions. Overall, for the entire corporation, what's best? What kind of overall decisions are best for the company? What areas of the world do you want to organize a subsidiary in and sell in and so forth, but you're looking at overall decisions. Now, it also improves the quality of decisions by delegating authority down the chain of command. Again, local managers might be able to know a lot more, probably do know a lot more about their local aspects of the business than upper management. It motivates managers to improve productivity. It trains lower level managers for increased responsibilities. Then they can move up in the ladder in the corporation as they gain more experience. And maybe it also will improve performance evaluation. So there's the organization chart again. Now, a responsibility center. Let's look at the definition here. An identifiable part of an organization where control over revenues or expenses can be assigned. Each of these boxes in this organization chart can be a responsibility center. And responsibility centers can be divided up into 3 main categories. The first is a cost center. A cost center is one that only incurs expenses. It itself does not incur revenue. This would be like a production facility. They only produce the product. They don't sell it. There's another division of the company that will make sales of the product their number one goal. A profit center, though, is a center that does generate revenue and incurs its own cost. So it might be evaluated on the profit it makes instead of just how much it spends compared to the budget, like a cost center would. An investment center is one more step above that, where the managers not only are responsible for revenues and expenses, but also they are responsible for the investment of capital, to purchase more assets to use in their division. So 3 different responsibility centers: a cost center, a profit center, and an investment center. Now, responsibility reports, we're going to take a look at one right down here. And a quick definition: management by exception. The philosophy of focusing management attention and resources only on those operations where performance deviates significantly from expectations. So you look for the exceptions and drill down and find out why you had the exceptions. Here is a responsibility report. Let me show you. It's quite lengthy. Look at this. And so it's starting here with the second level and third level and so forth. You can see lines coming up from each level. And so let's start at the bottom here. In the finishing department, that's part of production, then the person who is running the finishing department will need to be responsible for all these variances. And that person will need to find out, why was this one favorable? Why were these unfavorable? So this has more detail in it for this person. Now, what you'll do is take these bottom numbers here and put it up in the report for the person who oversees all the 5th level departments. And this is the production department. They'll have cutting, they'll have assembly, they'll have finishing, and they'll have their own supervisor salaries and administrative staff. So this number will come up in this line. This person finishing is only responsible for these numbers here. But one level up, this person who runs production department is responsible for all these. That includes all these here. Let's take it up another level. Let's go to the tables division. They're making several different kinds of furniture, so tables. So the person who runs the table division is responsible for production in that division. So all these numbers are summarized in this line here and dropped in on this person's report, production cost. This person is also responsible for sales, for planning, for accounting, and other costs in their division that they're responsible for. Go up another level. For the manufacturing division in general, which you'll have tables, and let me go up to the chart again, right here. The furniture division, carpet, sofas, and tables. So we've been going up from finishing to production to tables, and now we're going up here to the second level. And this person now is responsible for everything below. And so this line drops in here, and this person's also responsible for the sofa division, the carpet division. This company's, it's a separate company as part of the overall company. This person's salary and administrative expenses for this division. So this person is responsible for everything in the lower divisions. And as you bring the numbers up, you get less and less detail. The most detail, remember, it's all the way down here in finishing. All these summarize one set of numbers. They go in here, one level up. One set of numbers, part of all these other numbers. This set, the summary, goes up here, right into here. And overall, these numbers drop in to this person. This person's responsible for everything in the lower levels. But as you prepare a report for this person, some kind of performance report or whatever to show variances, the data needs to be summarized. You don't want to have all this other detail listed in this report or to be much too lengthy. So you summarize the data as you go up different levels. And you can prepare an income statement if you want to. Really nothing new there. Controllability concept. Let me take a look at this. Managers should be evaluated based only on revenues or costs they control. It's really not fair to evaluate someone on something they do not have control over. So that's the controllability concept. In a report you prepare for a manager, and you're going to use that report to judge the performance of that manager, you only need to have the revenues and the cost in that report that person has responsibility for and control over. Next page. Return on investment. You probably remember this from the first course. It's just simply in this course, operating income divided by operating assets. Okay, operating income divided by operating assets. That's the return on investment. And the reason we use operating assets is because some assets the person does not have control over, or maybe is not used in the operations. It might be in their division, but if it's like a sideline building that they recently took a division away from, it's not being used right now, well, it's not really being operated, so that should not go in the operating asset denominator for this equation. Looking at these numbers, we have operating income divided by operating assets for each division, and you can see what kind of return each division is receiving. 20% lumber, 18% home building, and furniture, 17%. And this is a way to judge and evaluate performance for people who are responsible for these three divisions. Okay, you can read through there. Talks about operating assets. How do you measure these? When you get into the reading here, you might consider that should you use original cost instead of book value? Your book value is based on original cost, but when you read this example here, you'll see that an older asset has more accumulated depreciation, therefore the book value is lower. That might make the operating or the return on investment look higher. So should you go back and use original cost? Again, that's the company's decision. Some accountants say, well, maybe that is not fair. Maybe we should use replacement cost rather than historical cost. Replacement cost is rarely used because it's just too complicated to find like a fair replacement value for every asset that you have. So usually ROI is based on some kind of historical cost figure, usually book value or the original cost of the asset. We can expand the return on investment equation out and have two different parts to it. Remember, the original one up above was operating income divided by operating assets. Now if we divide that and put sales in the denominator here and in the numerator over here, we have two aspects of ROI, one called the margin, and this is called the margin as a measure. Let's look at operating income compared to sales. This shows you how well you're controlling cost. Operating income, you have all the costs pulled away from sales to get operating income. Divide by sales, you're sort of looking at how efficient are you in controlling your cost, because what's left over after you pull away cost will be income. Over here it's called turnover, and you're trying to see, based on the assets I have control over, how much revenue am I generating? That's like a turnover. Okay. But you can see it all boils back down to return on investment. Once you get this number and this number, multiply, get the same ROI you would have before by dividing operating income by operating assets. Because algebra-wise, this sales would cancel this sales out, and you're back to operating income over operating assets. Some examples you can go through here, and you can see that once you have it divided out between margin and turnover, you can say, now what would the numbers be if I change sales? What would the numbers be if I reduced expenses? What would the numbers be if I reduced the investment base? So you can look at these yourself. That's all they're doing, is taking the original set of numbers and say, let's bump up sales. What are the results? Let's reduce expenses. What are the results? And then let's reduce the investment, and see what the results would be. Residual income is a very interesting area. Now, think about this. If a manager is solely evaluated, and maybe their bonus is based on return on investment, that person would not want to make a decision, like another investment decision, that would do something to lower the amount of return on investment they are already generating. So for example, let's say that the lumber manufacturing division, LMD, is currently at 20%. So that manager has an ROI of 20%. The company overall rate is 18%. And maybe the corporation is satisfied with 18%. But this manager is above that at 20%. Now, this manager has the opportunity to invest more funds, so they'll have more assets invested, and that investment will earn 19%. When you put that together with the current 20%, it's going to lower that person's overall ROI. It's going to be less than 20. So then, like this paragraph says, the manager might be thinking, I don't want to hurt my bonus. I don't want to look bad by dropping below 20%. I'm not going to invest in this new asset that'll generate 19%. Even though the company would be happy with that, I don't want to do it because it makes me look bad. That's where we can get into using residual income. And a decision like that is called sub-optimization. But residual income doesn't look at percents as the factor to evaluate someone. Residual income is operating income, but subtract out the desired rate of return times operating assets. So if the company in general has that desired rate of return of 18%, and the corporation in general is happy with that, and the manager is generating 20%, but the company is not going to look at the 20% ROI. If they look at residual income, that might help the manager make a decision that's best overall for the company. Not just best for that manager if you're looking at strict percentages, but look at income, look at more at the bottom line. So how do we do this? Let's say this person, we're currently at 18%, and so their residual income now, without the new investment, is 18% times operating assets, $54,000. Subtract that from operating income, so $6,000 is this manager's current residual income. So residual income is a dollar amount. It is operating income minus the assets that person has control over times the desired desired return on investment the company would like to have. So 18%, this person generating 20%, so they have a positive residual income of $6,000. Now, if they have the option of investing $50,000 that would generate 19%, again, if you just look at the 19% times the 20% compared to the 20%, no, you don't want to do it. But what about residual income? What residual income would this new investment generate for this person? If it's positive, probably should do it. If it's negative, no. Let's take just this investment. Operating income, it can generate 19%. So $50,000 investment times what it can generate, operating income will be $9,500. Residual income will be that same operating income minus the new investment times what the company would like overall. So we would like an 18% return. It's generated more than that, so that's going to look good here in just a second. So you multiply this desired income, 9,000, you get 9,000. Subtract that from the operating income from this investment, you have a positive $500 residual income amount. So even though, going back to the beginning, even though this manager currently has an ROI of 20%, this new investment generates 19%, and at first glance they think, I don't want to do that and lower my overall 20%. If you look at residual income, sort of more bottom line instead of just strict percentages, then this is what you end up with. You end up with a positive residual income from this new investment, and this will be added to the current residual income the manager already has. So the manager already has $6,000, add another $500, they look even better, and if a bonus is based on residual income, they would have the tendency to accept this new investment. So that's what this area is all about. You can read this yourself. You can read down through here. And the balanced scorecard, you might see this in other courses. Just a quick definition. A management evaluation tool that uses both financial and non-financial measures to assess how well an organization is meeting its objectives. Balanced scorecard. You're not just looking at accounting numbers, you're looking at everything. Financial and non-financial performance measures. Next page. Oh, the appendix, transfer pricing. Don't worry about this for the exam. And then that's the end of the chapter. So again, go back and read it yourself. watch the numbers, follow those through, and then good luck with your studies.